Hey traders, this is Ron Haydat, Markets Hammer. Happy Sunday. Hope you're having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or selling security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. Kick off here with the SPY, which I have a long-term bullish position in. Over the week, we essentially went nowhere. If I zoom in real close here, this was Monday, Tuesday, Wednesday, Thursday, Friday. We come right back down to where Monday was. So while we are just pennies below the 5-day EMA, it's still bulls having the overall edge. If I zoom out further, the highs back from January remain the target, which are about 4.5 points, or like 40 S&P points away. If we take a look at the DIA, which is the diamonds, they continue to lag. Zooming in here, same thing, finished the week where they started. They could not break out of this channel, so they remain stuck in their range. If we take a look at the Qs, they'll have some action this week with Amazon and Google reporting, but right now, same thing. Finished the week basically unchanged. They're a little bit below their 5-day, but overall, the trend here that we've drawn in, this upward trending channel, remains in play. The IWM, which is the Russell 2000, was down a little bit on Friday. For the week, though, it finished higher. We're still challenging that double top from late June and the middle of this month here in July. Taking a look at the VIX, with the markets up as much as they are, they're 1286 on the VIX. It was down below 12 at one point intraday. This is still very low, which is bullish for equities. Something I haven't looked at in a while was TLT, which are bonds. We did roll over on Friday. This was the old trading range going back over a year on a daily chart. Now we have the bottom here at the top. We could still call it up there. I can just put this across to give you the context. That trading range remains intact. Right now, support, we can go to moving averages like the 50-day SMA in orange, but really you're just range bound. So from a long-term perspective, it's harder to trade short-term. Hey, when the blue line crosses up through the red line, that's a buy signal, like it did here. When it crosses down through, it's a sell. And can give you an idea of, hey, if it's on a sell, I could look for bear calls. If we're on a buy, I look for bull puts. From a directional standpoint, I think it's even harder to trade with it being so gappy, which is typical, but we're in such an overall tighter range. It's not like we've broken out and we're rushing to new highs or new lows. It's harder, I think, to trade on a day-to-day swing trade, buying a long call, buying a long put type of situation. However, over the very, very short term, there are 2 attempts at moves up here and it failed. So even short term, there's a mini double top here for those of you guys that are interested. I do give the bears the edge here on bonds. Now, something I wanted to talk about and spend probably a good 2 minutes on or so is Skechers. We previously looked at Netflix, which is a very expensively priced stock. Buying 100 shares of Netflix can cost the price of a car. Here with Skechers, 100 shares is $3 grand, big difference. But the collar trade application can work practically on any price stock as long as the option markets are liquid. Now, last time Netflix had earnings, it went from 40s down to below 30. That was catastrophic for folks who held a lot of Skechers. So in this example, we'll take a look at the price of Skechers puts and short calls and look at what the options would be after the earnings report. Because the stock closed at 33.25 and it was actually sub 25 at one point. I've already done the work. So here's what we're going to do. We're going to go to the Analyze tab. I'm going to back it up to the 19th, which is the day before Friday, the earnings report. And typically, the minimum amount of time I want to use on a protective put is about 30 days. Ideally, I'm thinking 45 to 60, something like that. But because July expiration was Friday, there was no September in this option cycle yet. Now, come Monday, there'll be September, and then that would have worked. But in this case, it's really August or October. Let's just use August. Let's use a shorter term put. With the stock at 33, a $33 put, there was a 25-cent bid-ask spread. Again, this is end-of-day pricing, so I do think it is realistic where we could have gotten maybe a nickel or a dime off. And remember, this is always from an educational perspective and a virtual paper trading account. Let's just say we pay $265. So we have an at-the-money put. The delta is about 0.44. Stock drops $1. This option gains 44 cents. In theory, minus time decay and minus volatility reduction. Now, if I just have the stock and a put, my reward potential is still theoretically unlimited. If the stock goes to, $1 million, the put's worthless, but hey, the stock sure did appreciate in price, right? But it's more about capital preservation. That's what's so important here. All right, but there's one other thing I could do to help maybe lower the cost of my shares, and that's turned this into a collar trade. So again, if I was just wildly bullish on this stock plus long put, it to me would be good enough. However, if I had a short call, let's say here at strike 37, which is over 10% above where the stock is trading, I could take in $1.20 a share. Again, 25-cent bid-ask spread. I could probably maybe knock a nickel off that or something. There was only 17 open contracts as compared to 300 some over here, so it's definitely not as liquid. Typically, I like to see about 200 open contracts, in the open interest. That's just my humble opinion as a base minimum. And if I go further on that, I typically never want to be more than 5-10% of the open interest. It just creates a dangerous liquidity issue when you try to get out. The prices might be quite unfavorable. So anyway, now we have a collar trade. Long put 33, short call 37. If I fast forward one day, that 33 long put is now worth $6.60, and the 37 short call can be bought back for a nickel. So what ended up happening here? The stock went from, like we said, 33.25 to 26.27. But back to the analyze page, that means the stock dropped about $8. That's a lot. On a $30-some stock, $8 is huge. It's absolutely massive. But the put gained about $4. So it's better than the old sharp stick in the eye. You're at least plus $4 in the put, but you're down $8 in the stock. So you've covered half your losses at this point in theory. The short call, though, sold to open for $1.20. It's now at a nickel. Hey, that's about $1.15 in our pocket. So if you net it all out, stock down 8, put plus 4, short call plus $1.15, we're up $5.15 in the options market, down $8 in the stock. We're down $3.85 a share. That's not too bad considering the stock got killed. Now at this point, I could look to short a new short call because the stock is down so much. So maybe I buy to close that short call. I could come out here in October and add a short call for another $1, lower my cost basis even further. I could go closer to the money and take in even more credit, or I could wait till September options start trading on Monday, as in tomorrow, and then look to short a call there too, and then month to month, or if I wanted to do weeklies, try to lower my cost basis. But it's not always about making a tremendous amount of money. I mean, sure, we're holding stocks because we want them to go higher. That's the whole point, and I get that. But if we're wrong and the stock drops on an earnings report, whether the report's positive or negative, and there's just simply more sellers, this is how portfolios can get absolutely destroyed. And then it can take years and years or longer to actually get that money back. So walking in with a put here, once again, just like Netflix, can really save your bacon. And the other nice thing about collar trades is they can truly be tailored to a trader's expectation. And the one that I just outlined for you here as a hypothetical example, it's an at-the-money put. So if the stock drops, the put can quickly start gaining value. The short call was in play because I didn't think the stock could really go up more than 10%. That is a huge jump for a stock like this. Plus, the implied volatility on these options were off the chart crazy. I had one member write in saying that they were seeing implied volatility way over triple digits in some areas. It was astronomical. Therefore, adding a short call can really be helpful. And we saw how it worked out. Stock dropped and the short call could be bought back for a lousy nickel. Now, if I was more conservative, meaning I want to protect even more of my capital, well, then I could have come in here, moved the date back to the 19th, and instead of paying $3.80 for a $33 put, I'm sorry, that's August. Instead of paying $2.65 for a $33 put, I could have gone a little higher. Maybe I had to put it strike 35. That would give me a little higher delta. Or I could have moved my short call lower and really made it what they call a tight collar trade. There's a lot of neat ways to do it. And also, if I was really bearish, maybe, let's say I owned 500 shares of Skechers. I would typically buy 5 long puts. Maybe I would have bought 7. I could have bought a few extra long puts if I wanted to. But the one thing I wouldn't want to do is then do 7 short calls, because if I had 500 shares of stock with 7 short calls, that means 2 contracts are uncovered, meaning the risk is theoretically unlimited. And that is a real fact. And that's something we would never want to do, in my opinion. I would never want to have naked calls out there unless I truly understand the risk. And even then, I think it's just a dangerous way to blow up a portfolio. So I hope that was helpful. I know some of you guys wrote in with questions. What if the stock had done this and done that? With Netflix, it didn't move that much. You saw the implied volatility crash. Skechers, we had a big move and the implied volatility crashed. So if we have another big move and you find this helpful, we might be able to do another example on maybe Google, Amazon, 3M, AMD, Advanced Micro. Those are 4 stocks reporting this week. And then next week we have Apple. So start practicing, pick a stock that you see does have big moves. Try to apply these color trades in a virtual trading account. Most brokers out there offer that free to you as a service, and then see how these option values change. And it really could make a massive difference for you. All right. So with that, I wish you a fantastic week ahead. Happy Shark Week to everybody. Shark Week is going to be starting here actually in a few minutes, East Coast time. Again, have a great day. I'll see you tomorrow. Bye-bye.